welcome to the research desk. Imagine holding $1 million in cash right now in April 2026.
Right. Actual liquid capital.
Exactly. Inflation narratives are swirling, central banks are hoarding gold at record paces, and the yield curve is, frankly, a macroeconomic puzzle. Your gut tells you to aggressively buy gold and ditch the US dollar.
Which is what everyone is doing.
Yes, but what if the mathematics of the market tell you that your gut is entirely wrong? We have spent the duration of this series constructing, dismantling, and refining a recursive hedge arbitrage framework.
And today we reach the necessary conclusion. Theory has to eventually face the friction of reality.
It does. We are establishing the definitive closing argument of this framework by translating it into a live portfolio. We are taking the mathematical scaffolding we have built over 10 deep investigations and, well, applying it to a $1 million allocation of real capital.
A hypothetical $1 million, just to be clear.
Right, a hypothetical $1 million. My role today is to walk through this live April 2026 portfolio application. I will demonstrate how this framework operates as a rigorous diagnostic tool.
A diagnostic tool, not a crystal ball?
Precisely. It is not a crystal ball. It is a regimented process designed to quantify what we do not know, adapting to regimes, and isolating relative value across asset classes.
And my role is to serve as the necessary friction. A framework is really only as robust as its blind spots. Moving from a historical 108-month backtest to the allocation of live capital, it introduces extreme risks that just do not exist on a spreadsheet.
Which is why we need to stress test it.
Exactly. I will be rigorously stress testing every underlying assumption we discuss today. I will identify the vulnerabilities, the data constraints, and the structural limitations of our model. We absolutely must ask what goes wrong when theoretical elegance collides with real-world capital constraints.
Because conviction must be continuously challenged.
Right, particularly when a mathematical matrix spits out highly concentrated definitive signals, which, spoiler alert, it does today.
Let us establish the foundation of our position first. Over the preceding 9 investigations, we engineered a system that asked the exact same 2 questions at every level of asset allocation.
Is this asset overpriced as a hedge? And is it cheap relative to its peer group?
Yes. And we demonstrated that applying this logic strictly at the cross-asset level yielded a 0.94 Sharpe ratio.
Which is decent, but
we observed it fail spectacularly at the sector level without regime awareness. It dropped down to a 0.52 Sharpe.
Yeah, that was a brutal drawdown.
It was. But we watched it recover when we introduced a 3-layer regime adaptive system. That brought us to a 1.04 Sharpe ratio.
Let's translate that jargon into practical reality for a second. A 1.04 Sharpe ratio means the portfolio is delivering highly efficient risk-adjusted returns.
Right. It is smoothing out the ride. The primary virtue of this framework is its recursive consistency. It organizes information systematically.
By forcing every asset to justify its place.
Exactly. Through both a hedge function and a relative valuation, we strip away the noise of financial media narratives. The resulting matrix provides a highly functional, regime-adaptive view of the market.
But again, it does not predict what the market will do tomorrow.
No, it diagnoses what the market is mispricing today.
Well, that diagnosis relies entirely on the integrity of the data and the parameters we have chosen. And the counter-perspective demands intense skepticism of those choices.
Fair enough. Where do you want to start?
We're relying on a 108-month backtest. In the context of macroeconomic cycles, 108 months is a fraction of a true secular regime. It barely captures a single complete business cycle.
It's a statistically significant sample size for monthly data.
Mathematically, sure, but our logical scaffolding rests on real-world constraints that introduce severe fragility. We are utilizing interpolated quarterly data for velocity metrics.
Right, the M2 velocity.
Yes, which means we are essentially guessing at the monthly numbers by smoothing out quarterly prints. We are relying on manual estimates of structural bids. We are operating within a highly restricted 9-member asset universe.
Which was by design, to limit noise.
I know, but it limits our degrees of freedom significantly. An elegant logical structure cannot immunize a portfolio against the risk of structural breaks.
So you think the relationships might have broken?
I think when we take this framework into the live April 2026 environment, we are trusting that the relationships defined between 2016 and 2024 have remained stationary. If they have not, the framework is not diagnosing mispricing.
It's systematically executing errors.
With supreme confidence, yes.
Well, the test of that vulnerability lies in the output. We will systematically walk through the complete April 2026 cross-asset scoreboard.
Let's hear the numbers.
This matrix ranks our 9 asset classes by their combined hedge and arbitrage scores. A lower score indicates a more attractive asset. A higher score indicates an asset is overpriced or crowded.
So lower is better. Got it.
Let us examine the exact numbers the framework is producing today, because these numbers dictate the deployment of our hypothetical $1 million. The US dollar sits at 15. That is a strong buy.
15. Okay.
The 20-year plus Treasury, represented by TLT, is at 18. Strong buy. The S&P 500, SPY, is at 21. Strong buy.
That's a very aggressive top 3.
It is. Continuing down, TIPS, Treasury inflation-protected securities, are at 37, generating an accumulate signal. Real estate investment trusts, REITs, are at 35, also accumulate.
Right.
Oil is at 47, a hold. Bitcoin is at 47, a hold. Gold sits at 76, generating a trim signal. And silver is at 78, also a trim.
Wow. Okay, the stratification here is entirely distinct. The framework is heavily polarizing our options.
It is absolutely polarizing. The framework hates the middle ground right now.
The stratification is distinct, but we must dissect the mechanics driving these extremes. Raw scores do not pay the bills.
No, they don't.
If you were going to hand me $1 million and tell me to buy the US dollar at a 15 and TLT at an 18, those allocations demand immediate, intense scrutiny.
I welcome it.
Let us start with the dollar. Why is the mathematical system screaming to buy the dollar right now?
The US dollar commands this high conviction for precise reasons. The dollar is deeply cheap relative to its peers. It's registering an arbitrage score of 4 out of 100.
A 4? That is almost unprecedented.
It is incredibly rare. Simultaneously, it possesses a massive structural bid. We are tracking a $5 trillion per year Eurodollar rollover into a $30 trillion float.
Complete with a 1.5x unidirectional multiplier, if I recall the model correctly.
Exactly. The framework is capturing a systemic liquidity demand that entirely supersedes traditional valuation metrics.
Hold on. Let us translate that structural mechanism for a moment. You are referencing the Eurodollar rollover.
Right.
For clarity, we are talking about U.S. dollars held in banks outside the United States, which foreign corporations borrow to fund operations.
Correct. It's offshore dollar debt.
When you say a $5 trillion rollover, you are describing the plumbing of global debt. Foreign entities have borrowed dollars, and they eventually have to buy dollars in the open market to pay that debt back.
Which creates a forced buyer.
It creates a synthetic forced short squeeze on the dollar. But my pushback is this. You are taking a massive, opaque shadow banking phenomenon and distilling it into a single numerical score.
I am.
Is that a structural bid, or is it a localized liquidity crunch that the Federal Reserve could evaporate overnight with a single swap line?
It is a structural reality until the math proves otherwise. The hedge component of the dollar sits at 62.
Which is elevated.
Yes, it is elevated because the dollar does not act as a traditional hedge against domestic inflation. However, the arbitrage score of 4 overrides this entirely.
Because the relative value is just too extreme?
Exactly. The framework recognizes that when the rest of the world is desperately starved for dollar liquidity to service offshore debt, the relative cheapness of the dollar makes it the most attractive asset on the board.
Even if the Fed intervenes?
We do not need to predict the Federal Reserve swap line policy. We only need to measure the immediate relative demand. The model sees the demand right now.
Okay, I'll grant you the dollar demand for now. But what about long-duration bonds? You have TLT sitting at an 18.
Yes, our highest conviction fixed income position.
But the narrative right now is that inflation is a persistent structural threat. Why is the framework aggressively buying 20-year Treasuries?
TLT is one of the very few assets demonstrating a statistically significant sensitivity to the M2 money supply multiplied by the velocity of money.
Ah, the M2 velocity metric again.
Yes, we measured a beta of negative 0.225. And that comes with a t-stat of negative 2.30 and a p-value of 0.023.
Let me translate that math for a second.
Go ahead.
When we say a beta of negative 0.225 with that specific p-value, we are stating that we have high mathematical certainty that when the effective money supply expands in the real economy, long-duration bonds act as a reliable shock absorber.
They move inversely. Exactly.
They move inversely to the money supply shock.
Right. With the yield curve currently elevated and short-term rate cuts entirely plausible in the current macroeconomic environment, the mathematical alignment for long-duration treasuries is optimal.
So you're buying it for the structural inverse relationship.
We are buying a statistically validated shock absorber at a historically attractive yield.
Does a historically significant negative beta to M2 times velocity actually hold up if the yield curve shifts unpredictably? That is the rhetorical challenge the TLT allocation must face.
Unpredictably how?
You cite a beta based on a specific, bounded historical window. But what occurs if the structural regime of inflation volatility has permanently steepened the term premium?
The model accounts for regime changes.
Wait, hear me out. We could observe plausible short-term rate cuts from the central bank, satisfying the market narrative, while the long end of the curve sells off violently due to fiscal dominance.
Or concerns over massive sovereign debt issuance.
Exactly. The framework looks at the p-value and assumes the relationship between money supply velocity and long-duration bonds remains perfectly stable.
It assumes stability within a probability matrix, yes.
But if the bond market rejects the central bank's control over the long end of the curve, that statistically significant beta becomes a mathematical trap. It anchors us to a duration risk that the real-world market has already repriced.
That is precisely why the framework accounts for relative mispricing and why we do not allocate 100% of the capital to a single asset.
Fair. It's part of a matrix.
Which brings us directly to the most critical and arguably the most counterintuitive signal in the current matrix.
The gold paradox.
The gold paradox. We absolutely must spend significant time analyzing why gold is a trim at a score of 76.
Because to anyone looking at inflation data, selling gold right now sounds like financial treason.
It does. But to understand this, we break down the underlying mechanics. Gold's hedge score is 59. This is a reasonable, highly functional number.
So the framework admits it works as a hedge.
It proves gold is doing exactly what it is designed to do. It's acting as a robust hedge against inflation and systemic uncertainty. However, its arbitrage percentile is 93.
An arbitrage score of 93. Let us unpack exactly what that means for the portfolio.
It means that compared to its peer group over a trailing 5-year window, gold is historically overwhelmingly expensive.
It sits in the 93rd percentile of expensiveness relative to other assets.
Yes. The ultimate takeaway here is not that gold is broken or fundamentally flawed. It is that an asset can be perfectly executing its fundamental job, protecting against inflation, while simultaneously being mathematically toxic to your portfolio.
Toxic because of the entry price.
Exactly. Because the entry price destroys your forward yield. The framework's instruction here is highly specific. Respect the hedge, but do not add capital at these levels.
So if you own it, you trim?
If you already own gold, you hold a reduced position. If you do not own it, the framework dictates that April 2026 is mathematically the wrong entry point.
I will attack the relative valuation logic directly here. Let us inject some reality into the math.
Let's do it.
Central banks worldwide are currently buying $88 billion of physical gold a year.
It's a massive number.
They are injecting that massive price-insensitive demand into a $5 trillion free float market. We are forced to ask a fundamental question here. Is an arbitrage score of 93 actually reflecting overvaluation?
I argue that it is.
Or is it merely reflecting a structural break in the asset's core demand function?
The framework calculates relative valuation by looking at the last 5 years of peer relationships.
Yes, the 5-year trailing window.
But if the peer group itself is fundamentally mispricing geopolitical risk and sovereign entities are systematically accumulating physical gold regardless of price because they are weaponizing reserves, then trimming gold is a dangerous adherence to relative math over absolute reality.
You're saying the baseline has moved. Yes, you are punishing gold for reacting correctly to a macro paradigm shift. If the baseline has permanently moved, mean reversion to a 5-year average simply will not happen.
And the model will just keep screaming trim.
Exactly. The model will continuously signal trim throughout the entirety of a secular bull market.
Well, if a secular bull market requires us to buy an asset at the 93rd percentile of its historical valuation, the framework prefers to miss the marginal upside rather than absorb the asymmetrical downside risk of a mean reversion.
It's a conservative stance.
That is risk management. Furthermore, the framework does not view assets in isolation. The cross-asset matrix we just detailed is layer 1.
Right, the macro layer.
It informs the direct construction of the hypothetical $1 million allocation. Based on the scores we walk through, a score-weighted portfolio takes exact physical shape.
Let's build the $1 million pie.
We allocate 25% or $250,000 to 20-year plus Treasuries. We allocate 20% to the S&P 500. We allocate 15% to U.S. dollar instruments.
Okay.
We put 10% into tips, 10% into REITs, and 10% into oil.
And the crypto and metals?
We allocate 5% to Bitcoin, a mere 3% to gold, and 2% to silver. This distribution is the direct mathematical translation of the cross-asset scores.
It is a highly decisive, almost aggressive allocation. 25% to long-duration bonds and only 3% to gold represents a massive concentrated macro bet.
A bet on what?
Disinflation and dollar dominance.
It represents recursive consistency. The decisions made in Layer 1 fundamentally and systematically shape the sector choices in Layer 2.
Right, the subsector selections.
Exactly. The framework explicitly prevents internal contradiction. Let me demonstrate how macro dictates micro here. Because gold is at trim, the framework explicitly tells us that inflation hedges are overpriced.
So you don't buy inflation protection in the stock market either.
Exactly. The immediate legal implication for Layer 2 is that we do not chase pricing power sectors like energy or materials based on an inflation narrative.
You're starving them of capital.
We systematically starve those sectors of capital because the overarching macro signal says the inflation trade is crowded. Conversely, TLD is a strong buy.
Which implies falling rates.
A high probability of falling rates, yes. Therefore, rate-sensitive sectors like real estate and utilities receive a structural tailwind in our Layer 2 allocation.
Makes sense mathematically.
Furthermore, the U.S. dollar is a strong buy. That dictates a strict preference for domestic revenue sectors, such as utilities and healthcare.
Over export-heavy global supply chains.
Yes, because those global supply chains will suffer under the weight of dollar strength. Finally, because the S&P 500 is a strong buy, the equity allocation remains at or above neutral, and we deploy the V2 regime adaptive blend.
Remind me how the V2 blend distributes that equity weight.
This blend shifts our equity weights between contrarian, momentum, and defensive postures based strictly on whether the underlying economic regime is categorized as transition, expansion, or late cycle.
Let us follow that logic down the rabbit hole, because I think this cascading effect is exactly where the rigidity of the framework becomes a systemic liability.
How so?
Let us pursue the constraints you just outlined. If the Layer 1 signal on gold is a false positive, if it is registering as expensive merely because of the structural central bank buying we discussed earlier, doesn't the framework automatically sabotage Layer 2?
It would cascade downward, yes.
By taking a false trim signal on gold and cascading it downward, the model systematically, legally prohibits the portfolio from buying materials and energy sectors just as an inflationary boom begins.
It assumes the inflation boom is priced in.
But you have built a deterministic chain. A single misinterpretation of a macro variable at Layer 1 prohibits the portfolio from participating in the very sectors that would protect the real purchasing power of that $1 million.
That's a valid concern, but
the recursive consistency you praise is also recursive failure if the initial input is structurally flawed.
to prevent that exact scenario of recursive failure, the framework demands rigorous verification before execution. We do not blindly follow the matrix.
Right, the 5 rules.
We introduce 5 strict consistency rules required before taking action. And it is imperative to note that the March 2026 data passed 5 out of 5.
Let us walk through the mechanics of these rules deliberately because they really are the circuit breakers of the portfolio.
Rule 1 is oil reflexivity. If oil is up 10% or more over the past month, We must see gold positive year-to-date, the VIX volatility index above 20, junk bond spreads widening, and the S&P 500 negative year-to-date.
Because we need to know if the oil spike is actually hurting the economy.
Exactly. It checks if commodity strength is actually signaling systemic inflation stress that is damaging the broader economy, or if it is just a localized supply chain hiccup.
If it's just a hiccup, we ignore it.
Right. Rule 2 checks the defensive cyclical spread versus regime direction. The year-to-date and 3-month spreads between defensive and cyclical equities must agree.
And if they conflict?
If the signals conflict, it halts allocation entirely.
And Rule 3?
Rule 3 analyzes the value growth spread. If hedge demand is rising across the portfolio, value stocks must be outperforming growth stocks.
Because value is traditionally a safer harbor?
Yes. If growth is still leading while hedge demand rises, the hedge signal is a false alarm. Rule 4 demands hedge demand convergence.
This is the big one.
The VIX, junk bond spreads, and the put-call ratio must move in unison. They're the 3 pillars of market fear.
Right. Equity volatility, credit risk, and options protection.
If they do not agree, the fear is not systemic. Finally, Rule 5 examines the bond-gold correlation.
Let's hear it.
If long-term bonds, TLT, are falling while gold is rising, the market is actively pricing in inflation. This overrides the baseline arbitrage scores and manually shifts our hedge preference to gold.
Which solves the gold paradox issue we talked about earlier?
Theoretically.
Theoretically, yes.
Passing 5 out of 5 rules means the signals are internally verified across multiple dimensions of the market.
Well, passing 5 out of 5 rules on a monthly time frame provides an illusion of safety.
An illusion?
Yes, these monthly checks are designed to filter out noise, but what happens during a severe intraday shock where hedge demand convergence fragments?
Give me an example.
Imagine a sudden liquidity event. It is the middle of the month. The VIX spikes violently, but junk bond spreads temporarily tighten due to a specific central bank intervention facility.
While the put-call ratio goes entirely rogue due to algorithmic hedging cascades.
Exactly. Rule 4 fails. The framework's mechanical response is to reduce sizing and weight.
Because it doesn't understand the environment.
But in an environment where volatility interpolates faster than the monthly data updates, weighting is a massive position in itself. Do these monthly checks provide a false sense of security?
They enforce discipline.
They assume the market behaves in measurable, polite, monthly increments. When a real structural break occurs, the correlations do not politely wait for the month-end print to notify the model.
If the data fragments, the framework scales back. It actively protects capital by quantifying its own confusion.
By just refusing to play.
Yes.
Which brings us directly to how we utilize entropy-based signal confidence as a sizing tool.
The information theory component.
Right.
Information theory in practice dictates that entropy changes how much you buy, not what you buy. We measure the dispersion of agreement among an asset's peer group.
Let us look at the confidence scores then.
The US dollar carries a confidence score of 0.95. That is high confidence because all peers agree the dollar is cheap. It sits in a remarkably tight 2% to 8% range across all relative metrics.
So every metric agrees it's cheap.
Yes. That generates full conviction. The S&P 500 carries a 0.82 high confidence score. Bitcoin shows a 0.56 medium confidence score.
And gold?
Gold, however, has a 0.15 low confidence score.
0.15? That is incredibly low. Why?
Because peer disagreement is massive. Gold's arbitrage percentiles range wildly, from 5% versus silver all the way to 97% versus the S&P 500.
So depending on what you compare it to, it's either cheap or historically bloated.
Exactly. The composite score of 76 masks this fundamental disagreement. Therefore, the low entropy score mathematically forces us to reduce the position size regardless of what the baseline matrix suggests.
I fundamentally challenge the entropy thesis as a measure of safety.
Go on.
Let us use an analogy to examine the US dollar's 0.95 confidence score. Think of entropy here like a crowded theater.
Okay, a crowded theater.
A 0.95 confidence score means every single person in the room is rushing toward the exact same exit door, the US dollar. You state it means there is absolute consensus among the peer group that the dollar is cheap.
Mathematically, yes.
But isn't maximum peer agreement just a quantifiable definition of a violently crowded trade? The model reads that unanimous agreement as safety.
It is safety from a relative valuation standpoint.
But in the real world, when everyone is crowded at the same door, that is exactly when a spark causes a catastrophe. If every single relative metric agrees the dollar is the place to be, that means every systematic fund utilizing relative value logic is already positioned there.
You think there's no marginal buyer left?
Exactly. There is no marginal buyer left. Why should we view total market consensus as a signal for full conviction? In financial markets, total consensus is the primary warning sign of systemic fragility.
Because it means the trade is exhausted.
The framework interprets lack of disagreement as safety, when historical precedent suggests lack of disagreement is the exact moment maximum risk is achieved.
That is a compelling framing, but it conflates two different mechanisms. It is not a consensus of market participants holding the asset. It is a consensus of mathematical relationships across independent asset classes.
But algorithmic funds trade on those exact same mathematical relationships.
True, but there is a profound structural difference between market sentiment and mathematical relativity. However, we must address the honest limitations of this architecture.
Yes, we definitely must.
You have raised vital structural concerns throughout this analysis, and a rigorous framework must meticulously list its own boundaries.
The boundaries are severe, and we must formalize them for the record. First, the 108-month sample size is inherently limited.
It is a specific window.
We calibrated and tested the model on the exact same time frame. True out-of-sample validation requires applying the 2016 to 2022 calibrated model strictly to untested 2023 to 2026 data without a single modification.
Which we are doing with this live April 2026 portfolio.
Right. Second, the reliance on M2 velocity data is a glaring structural vulnerability. We discussed this briefly earlier.
The quarterly lag.
Velocity, the speed at which a single dollar bill changes hands in the real economy, is reported quarterly with a 2-month lag. The framework interpolates this to a monthly frequency.
To align with our other metrics, yes.
That introduces massive smoothing errors into our beta calculations. We are making highly concentrated bets on monthly data that is essentially mathematically smoothed fiction.
It's an approximation, not fiction.
Third, the 9-member cross-asset universe provides highly limited degrees of freedom for our arbitrage estimation.
We excluded a lot of assets.
By excluding global currencies, emerging markets, and broader industrial commodities, we are forcing the framework to find relative value in a highly restricted vacuum. These are not minor technicalities.
No, they aren't.
They are structural fissures in the foundation of the portfolio.
I embrace those limitations. In fact, identifying those boundaries is exactly what validates the process.
How does limiting the universe validate it?
We must explicitly call back to the key lessons from this series to prove that quantifying our ignorance is our greatest strength. In Episode 1, we proved that money printing, specifically M2 times velocity, has 0 monthly predictive power for 7 out of 8 asset classes.
Right, the liquidity myth.
We destroyed a pervasive market myth that liquidity guarantees monthly returns. In Episode 5, we documented the total failure of a pure sector contrarian approach,
which underperformed the S&P 500 by a staggering 7.8 percentage points.
Exactly. In Episode 7, we autopsied the whipsaw failure of our initial V1 model, exposing how momentum without regime context destroys capital.
That was a painful autopsy to walk through.
It was, but in Episode 8, we engineered the V2 3-layer fix, creating the regime adaptive structure we use today to solve that exact problem.
Adding the macro constraints?
Yes. And in Episode 9, we reframed value not as an absolute metric, but as a regime conditional one, and proved that alpha is multiplicative, not additive.
So you're saying the failures built the current resilience?
The negative findings matter precisely as much as the positive ones. A model that openly states it cannot predict the monthly movement of 7 out of 8 assets and restricts its universe to what it can measure is vastly more trustworthy than a black box claiming universal predictive applicability.
Trust in a model must always remain entirely conditional, though. The historical autopsies you reference demonstrate exactly why. Iterations are required because markets evolve faster than equations.
I completely agree.
The transition from theoretical backtests to a live $1 million portfolio requires us to maintain absolute intellectual humility. We cannot allow the elegance of the math to override the reality of the macroeconomic environment.
The math is a guide, not a religion.
Exactly. The vulnerabilities we discussed, the interpolated velocity data, the crowding risk disguised as entropy confidence, the absolute reliance on trailing relationships in a world of structural breaks, these remain active, potent risks.
We have to watch them constantly.
The framework is highly sophisticated. It organizes information brilliantly, but it is not infallible.
The goal of a framework is not to tell you the future with certainty. It is to make sure your portfolio is asking the right questions before it takes risk.
This is the research desk officially signing off.